7/8/2012. It's a Sunday. It's 11:51 a.m. Pacific Standard Time, and earnings season starts tomorrow. It'll start with Alcoa, and we're going to look at the S&P 500 calendar yearly lows. Again, we shorted this S&P way up here. When we called the bottom, it lived up to our expectations. It came up and hit our 1373 area where we got net short. One of the things about the standard weekly chart is the 10-week is declining for the rally up there. We had all of the austerity around the world. We had the Ben Bernanke QE3 causing volatility. We had central bankers around the world kicking in full steam. When we got down here where the markets were about to snap their back and break the 2012 lows, they were close. We've rallied up into the short. What we see happening is that the broader S&P 500 will start their earnings session starting very light week on Monday 7/9 and continue through the month of July. And that the yearly counter rally, we had rally 1, we've had the correction that we called for, and rally number 2 to resistance. The current lower support level will be what happens when the S&P comes down here and tests the resistance level right here where we had and where we broke down. And where are these areas at 1296 and 1317, 1315, and where this down, so they sold in very narrow weekly sell. It was only one day. And we had the holiday rally, 4th of July, Independence Day in this whole area. But the problem that I'm having is that we know that the broader S&P 500 earnings are not going to be good. Some have been marked down, some haven't. Therefore, we see that if the S&P comes down and tests the 100-week moving average at 1260, that would be a lower low of the year in the month of July. If they're going to have QE3, well, you would mark the earnings season down, you would mark the markets down, then Ben Bernanke would come in, save the world in August, right along with the muscle power of the other worldwide bankers around the world. And then if it looked like Obama was going to come off and not be president, and there was going to be a change, and we could grow this economy, well, we could set up a nice rally. But however, right now, in the shorter term, S&P is vulnerable to the earnings season. Listen, QE3 and all of that is just volatility at these bottoms. It's been a real bear and bull scrap. We had a nice rally, about 100 points, close to 100 points in the S&P to the major resistance level. We're calling for a reversal level, close back below the 20-week. The 10-week is tilting down. The weekly part of what we're looking at is that we never got into a weekly sell signal, and it's maintained to hold it in calendar 2012. It's going to take one hell of a lot of stimulus, but we don't see right now what that visibility is, that any move in volatility to the higher resistance levels, we're going to be selling short, just like we did over here, and just like we did in here. And when we went long here and buying the dips up to that resistance level, any resistance level up, we're going to sell. If we come down and hold support levels, moving through the calendar month of July, we'll look at where we can start having interaction. Right now, what I see is a declining 10-week crossing over the 20-week, and it's mathematically going down in earnings season. Look for lower prices in the S&P 500 throughout the calendar month of July, within the volatility measures, and all of worldwide central bankers trying to come together to save the world's slow growth, including China and everything else. S&P has a lot of high risk during this particular month of July.